Hey everybody, Marty Mazzori here. It is the 15th of November 2024 with your weekly video update. What I want to do is talk again about this unique short-term move or moves in markets. And first of all, I want to qualify that with normally we wouldn't spend a lot of time on such a short-term move for obvious reasons, but of course this is unique. This is the move since the election. We want to see if we can glean anything from it in terms of go forward, possibilities or probabilities. I'm not saying we can. I'm just saying it was unique enough and impactful enough on our core allocation to talk about. So what I want to do is talk about what I reported on Tuesday and then update those numbers for you today. So to begin with, I summarized everything that's in here, and we don't need to go through all of it. I just want to touch on these market moves. So as of Tuesday afternoon, 6 of the 11 U.S. sectors, call them the major sectors that we track, were actually up a bunch. 5 were actually down, I would say modestly. The U.S. was really certainly the only major equity market that was in the green. The others were notably in the red. We're going to update that as well. Among the major industrial commodities that we track, all had sold off significantly, save for natural gas. Among the ag commodities we track, 8 were up, 6 were down. U.S. Treasuries were getting pretty pummeled as interest rates went higher. Investment-grade corporate bonds were flat. They were actually up a little bit at the time, and junk bonds were up slightly. Also talked a lot about valuations. I don't think I'll get into that today, but that is a very important topic. Suffice to say, foreign equities are outright cheap, but incredibly cheap relative to the U.S. Doesn't necessarily mean they're going to go up. It just means on a relative basis. And that U.S. equities are historically expensive by just about every metric. Now, recognizing that there's a lot of concentration in those U.S. averages that these valuation metrics are based on. So there's going to be pockets in the U.S. of value, which we're constantly trying to ferret out. ZipRecruiter gave a not-so-rosy outlook on the U.S. economy, and then I talked about some other stuff. So if you didn't read this one, I think it was a good one, perhaps an important one to read. But for today's purposes, I just want to get into this. So again, 6 of the 11 sectors were up a bunch. Financials were up 6%, industrials up 4%, financials up 3.5%, consumer discretionary up 7%, energy up 4%, healthcare, staples. You can see they were just down, just modestly. REITs were down the most. Telecommunication was up 4.06%. So let me just pull that aside and go to that update first. So again, financials at that point, just 3 days ago, were up 6%. Now, since the election, they're only up 0.5%. Industrials were up 4%. They're actually now down 2% since the election. Materials were down 1%. Now they're down almost 4%. Tech was up 3.5%. Now it's down 1.8%. Consumer discretionary was up 7%. Now it's up 1.5%. Energy was up 3.9, now it's down 0.6. Healthcare was down 0.1, now it's down 4.2. You get the picture. Consumer staples were down 0.2. They're actually now up almost 0.75%. Utilities were down 0.07. They're up 1.7%. REITs were down 1.2. They're up 0.3. Telecoms were up 4. Now they're down 9. So it's the same ratio, 6 up, 5 down. But as you can see, a lot's changed. So what does this reflect? This rally that we've seen since the election is the definition of concentrated and probably not indicative of much just yet. I think the signal from the bond market and perhaps from the metals markets maybe is more telling about the future than the equity markets. But still on equity markets, what was really telling, and as I said in this blog post, really expressed in global macro portfolios like ours, while folks might have thought, hey, I must be catching a great rally, they really weren't. Why? Because the only thing that was moving higher was the U.S. by 3.4%. As you can see, developed foreign markets in general, the Eurozone, Asia Pacific, emerging markets in general, and then Latin America, they were all down. Updating you on those numbers. We have the S&P was up 3.4 and now it's up 1.5. The foreign securities were down 3.5, now they're down 3.9, about in the same place. Eurozone securities were down 5.6. They're actually a little better. Now they're only down 5.3 for the same time period. Asia Pac was down 2.4, down 3 now. Emerging markets complex was down 3.7, down 4.8. Latin America was down 1.5, now it's down 2.7. So since midweek, U.S. has taken a pretty good hit. The other ones are still down. And then I'll do it backwards here. Commodities, there was only one major commodity that we track here that was up, was natural gas. That's still the case. You can see oil's down, WTI and Brent's down a bunch. Gold's down a bunch, silver's down a bunch, copper's down a bunch, platinum, palladium, and gasoline all down. And a few days ago, pretty much the same, as you can see certainly there. And then ag commodities, we had 8 up, 6 down, and then bonds, we had treasuries getting whacked pretty good, U.S. investment grade down just a little bit, and high yield up just a little bit. As for ag commodities, now it's no longer 8 up and 4 down. It's only 5 up and 9 down. And then in bonds, junk bonds holding up just a little bit, call it flat. That's HYG. LQD would represent investment grade corporate bonds. They're down 0.9. And treasuries are down even a little further than the other day. So what does that represent, folks? That represents, since the election, that perhaps that stimulus that's promised will actually move the needle on the economy even further to the positive, which then would suggest that the Fed really doesn't need to cut interest rates anymore. This morning we had retail sales numbers that were better than expected, and we've had commentary from Jerome Powell and at least one other Fed governor who said, we can probably really go easy on Fed cuts with this economy doing so well. And then you get the other dynamics of promises about trade restrictions and that sort of thing, that in an economy that's still relatively strong, that would just add to the inflationary pressure. So in a market that's already trading at record valuation, that's really all about stocks going up, not about earnings going up. And we really need to touch on the topic. We're not going to today, but we've been talking a lot about it internally, of what earnings expectations are next year relative to probably the reality. Even in a soft landing scenario, we don't get to the earnings estimates that are priced into the U.S. market right here. It does not mean that the market won't continue to price higher growth even further out, and that we won't be sitting here months from now at still higher levels. I'm not saying that's not possible. I'm just saying that this is the kind of valuation setup and the kind of earnings estimate setup that without a perfect, it's like price for perfection, without a perfect scenario going forward, notwithstanding positive fiscal policy and the things to come, that's just a tough market. Certainly tough to go barreling into. While we have definitely made some adjustments, we now own small cap stocks and we haven't for quite some time. They would do well in a higher dollar, domestically oriented policy, if you will. And we've added a couple places to U.S. equities that we think represent value in a positive scenario going forward. But I would say that it's all pretty much at the margin. We're not willing to, because of the election results just yet, or for any other reasons, throw all caution to the wind with all the other fundamental factors that we have going against the market, I think, going forward. With regard to our core portfolio, as some of you have noticed, and then as I just kind of expressed, if you're in a well-balanced global macro portfolio, you haven't had a great run since the election. The only thing that has been your U.S. exposure. But then you have days like today, which, for example, those of you who are watching the market very closely, the Dow is down over 300 points, 0.7%. And it's actually the best performing of the U.S. averages. The S&P equal weight is down 77 basis points, 0.75%. The S&P is down 135 basis points, 1.35%. And the NASDAQ is down 2.5%. The volatility index is up a bunch. So this is a pretty ugly day for the U.S. market. All the while, our core, which is the epitome of a globally balanced portfolio across asset classes, as I look, is down, but it's down 0.05%. So call it perfectly flat on a day when the markets are just getting kind of pummeled. By the way, I'm still not bearish for the end of the year. I think a Santa Claus rally here is certainly not out of the question. Right now, the market is reeling against a very concentrated place. Reality is kind of setting in. Again, just didn't get participation from all the sectors, or certainly from global asset classes or equities like one might have expected. And it also represents the fact that sentiment got way out over its skis the last few days. So we have a fear-greed index of our own, which suddenly started sending big red flashes that people were too optimistic and getting too far over on the bull side of the boat. You get a CPI number like this week's that was a little better than expected, a producer price index number that was a little better than expected. Actually, CPI came in at expectations. PPI was a little too hot. Fed commentary that said we may not have to aggressively lower interest rates, and yields spiking, and suddenly people that were just throwing all caution to the wind get cautious, and you get a day like this. So I'm not putting really any more importance on today's sell-off than I was the last few days' rally. I think a lot of it is noise. I think the rally was a lot of short covering, as I explained, I think on the last video, and so on. Okay, so enough of that. Our economic index, the PWA index, for the third week running, showed no change. Retail sales were a little better than expected. Interestingly, the market sold off on that news at 5:30 a.m. in the pre-market Pacific time. The reason being is because if the economy is actually going to get better, that could be inflationary, or at a minimum, it could keep the Fed from cutting rates any further. And this market at these valuations probably needs the perfect scenario where the economy doesn't roll into recession and the Fed continues to reduce the Fed funds rate. NFIB, small business sentiment, is one of the components or the inputs to our index. A nice little pop here in October, still at a historically low level. Hiring plans were flat. CapEx plans picked up, but if you run these things back, still historically low levels. But this was before the election. So I think some election certainty would probably show small business optimism picking up noticeably here in the next month's survey. The U.S. Economic Surprise Index continues to go nicely in the right direction. This is economic data coming out better than what economists had previously estimated. But again, a good, strong economy means potentially a rekindling of inflation, and that is problematic for the market. I mentioned CPI, 2.6% on the headline, 3.3% on the core, 0.2% month over month on the headline, 0.3% on the core. Producer price index up 0.2% on the month. Headline 2.4, core index 3.1. None of that is at the Fed's 2% target, by the way. And you can see that it looks like maybe inflation is bottoming, could be problematic. Copper has been getting pummeled. Copper is very important to watch. It's considered representative of the strength of the economy or lack thereof. It's also representative of sentiment over China. They're going to be stimulating probably more aggressively than people had expected, but the market wants more. There's been some disappointment there and so on. So we'll see. Copper is important to watch. I thought I'd throw this one up there. This is our consumer staples to consumer discretionary stocks ratio. Typically, when staples are outperforming discretionary, which was huge as recently as August, right? That says something about market expectations. And when staples are outperforming discretionary, that says there's a lot of risk in the economy, and it tends to be a signal that recession is coming. Well, you can see that's all but gone away. And until just recently, discretionary stocks have been rallying big time relative to staples. They're both up on the year, but staples are underperforming discretionary by about 7%. So obviously this went from a negative to a positive signal in our economic index. And then to the technicals on the market, pardon the busyness here. So we'll just in the interest of time, we'll just do the one-year daily chart. So this is the S&P 500. Remember, folks, we've had this rising wedge pattern, those divergences that I'll show you in a second. We came right back up to this resistance, which was the uptrend line, and then failed. That's a very bearish look, and we're about to maybe refill this gap that we got right in here, right? Gaps tend to be filled, so that would bring us down even further before this little episode plays itself out. In terms of divergences, long bearish divergences on momentum, doesn't mean necessarily that the market's a sell, but unless these divergences get taken care of with more momentum, then typically, they're resolved lower. So here we almost about to a sell signal here on the MACD. We break down below that 50-day moving average, and technically things are not looking good in a hurry. The NASDAQ 100 ETF that we track bounced out of the top on this rising wedge pattern and then failed, and there's nothing worse than a failed breakout. This looks like an island pattern or an island reversal. It's where you get a gap up and you get kind of this cluster, kind of an island floating around up here. That has been a very reliable bearish indicator when it occurs up here. So this would suggest there's more downside before it's all said and done. Also losing that important 20-day moving average on the Qs. I'm not as convinced that this is all that bearish in the short run with the seasonality that we have ahead of us, but technically definitely something to pay attention to. And these divergences, and we're about to get a sell signal. Looks like we actually are here on the MACD. And then the dollar, remember folks, we've been calling this one pretty well here of late. Back in here, the world was bearish, the dollar, and we said, no, this is a very bullish pattern, and man, was it. So then we really had these kind of two different flags depending on what we're looking at. I really didn't expect this much, but it looks like this is the big long flag pattern that is playing itself out right here, if you will, which takes us up to this level. It was interesting that this should have been a headwind for stocks, or typically would be, doesn't have to be, but the way the market's been trading. And I said, if this keeps up, it becomes a headwind for stocks. Well, as I just showed you, the market is beginning to roll over a bit. So I think now the rising dollar is becoming problematic even for U.S. stocks, potentially. The 10-year yield, again, was able to rise with stocks there for a while. That really can't hold up at these valuations. If yields are going to go higher, stocks are probably going to go lower. But what do we have here? We have a rising wedge pattern with bearish divergences that would suggest that yields are due to turn around. The headlines, the data that's come out suggests that doesn't make a lot of sense, but we're at levels right now and we're losing momentum right here. So the technicals are definitely at odds with the headline data that's coming out. So we'll see how that plays out. This doesn't have to play out. It's not a sell signal until it drops below that trend line, but it looks very suspicious, which would be yields coming down, which all things equal should be good for stocks. Gold, we got lucky, let's say, on our gold hedge. Remember back in here, I was saying this thing's probably going to roll over, but I didn't feel like we needed to hedge it. Right about here, I changed my mind. I said, there's enough downside here, and our position is big enough that I don't want to let it go. We're bullish gold on a multi-year outlook for fundamental reasons, but right here, we got pretty bearish, and so we hedged it with a 3% put out of the money. It promptly fell out of bed. The hedge was up like 170%. So we rolled it down to just below the money. And then, so then what it leaves us with is a free hedge because we got all our money back plus some. And then the hedge that we're in right now is up about 50%. So these aren't massive dollars because it's not a massive position. I mean, it's a good sized position, but essentially what we did was exactly what we set out to do, and that is mitigate the hit that we would take if gold were to get slammed. And then, the rest of this is what I already showed you comparing to the written blog. So, folks, let me just do a hard stop right there. Hope that was all helpful. In a nutshell, don't be surprised to see the market recover between now and year end, recover from this pretty ugly week that we've had. Going into next year, there is a lot to parse. It's all about how it all comes together within the context of the overall global setup. So our job is to exploit the opportunities where we think they can be safely exploited, but perhaps still more importantly, protect against something potentially ugly to the downside as we go. We are very comfortable with what we're doing right now, hedging, looking forward to the beginning of the next cycle once we get through the next few months and this very late cycle scenario plays itself out. We think there's lots to take advantage of, but right now we still have to stay on our toes. Folks, thank you so much as always for watching and listening. Hope you all have a wonderful weekend. Take care. Bye-bye.